Hello.
Hello, Adam. Hello, Simon. Can you
Hi,
hear
how
me?
are you?
Good, and you?
Yeah, not bad. I'm just
Sorry for the delay.
oh, no problem.
We had a mix-up in
Ah,
the schedule, but now all is good.
ah,
Hi, Adam.
How you guys doing? You can hear me all right?
good
Yes.
morning,
Oh,
Adam. Yeah, I hear you fine.
you have a
Well,
very
This is
good
my new
welcome to the
microphone.
Frog
microphone.
webinar to begin
Yeah,
with.
I was
This is the
saying a
microphone.
very good microphone that you cannot hear any noise around.
Yeah, that's very cool. Cost a pretty
Yeah.
penny, but it's very cool.
You know, when you want to have pretty things. All right.
Okay, I am all good to go. So I'm going to quickly share my screen.
Mhm.
Um,
Give me a moment. I
there we go.
make you
I'll,
presenting. Yeah. Okay.
so yeah, I'm all ready. Have you also got a salmon colored shirt on, or Simon, or is that just the light?
It is salmon, pinky. Yeah,
I didn't hear the second word, but I heard salmon. That's okay. That's okay.
yeah, pinky colored shirt.
Yeah, no, I didn't hear that. Sorry, I just heard salmon. So yeah, because I'm a guy and we don't wear it. No, I'm just kidding.
Oh, I see, right.
Leander's been pushing for me to wear this color for 4 years now. So we're together 5 years in next month. So yeah, there's lots to talk about. I'm really excited. There's lots to talk about. There's lots of real world stuff happening. So we've got lots of markets to look at and lots of things to talk about, by the way.
All right.
Terrific.
So let's get started, though. So
yeah, sorry.
Do you want me
Please
to
go.
start?
Oh no, I'm gonna introduce
Okay.
our guest now, if I may. Welcome everyone to today's session. I'm Filippo Basagni from Fineco Bank. Today we are going to show a live market analysis and the current trade opportunities. So we will learn more about how to read the price action, identify potential areas where the market could reverse, and then can help to be a better trader, as our guest will describe. Before going to the details with our guests, let me not shortly focus on the very competitive prices that Fineco Bank offer. To open an account with Fineco Bank, there's no minimum deposit, inactivity fees, or monthly fees on a general account. For stocks, the commission are flat fee, and it depends on where the stock is traded. For instance, on the lessee market is £2.95, on US market is $3.95, and on European markets is €3.95. This means that no matter the counter value of your order, the commission will always stay the same. Talking about CFDs, we are even more competitive because we offer zero commission trade on UK, US, European shares and indexes with no additional spread applied. So today's guests are professional fund trader Adam Harris and round-the-clock trader CEO Simon Campbell. So let's now begin our session. All questions are more than welcome. Please use the chat below the window if you want to make any question to Adam and Simon. I'm going to share with you a link to schedule a demo session. That is a group session that we organize with one of our trainers that help you to improve your trading and understand how our platform work, especially the new platform, the Fineco X. I will leave now the floor to you both. Thank you.
Adam, shall I just quickly say hello before we get started? Welcome, everybody here. Thank you for attending. We're at a new time this month at 11 o'clock. We normally do these things at 5 p.m. So thank you for joining us in the morning. Great to have you. We've got an hour, which is not a lot of time, so we're not going to spend too much time on the introductions. Just to say that I've been working with Adam for, I think, 6-7 years now, and a very accomplished, seasoned trader, self-taught. I think, Adam, you'll say you were in another business which you sold, and then sort of taught yourself to trade and started to coach other people. So much so that you're trading your own funds now as well. We're talking about technical analysis predominantly today. We're looking at trends and turning points. So I'd like to hear from anybody that's in the webinar as well. Do let us know if you look for reversals. Is that a strategy you use? Hopefully we can engage a little bit instead of just being a one-way seminar. Last month was a bit one-way, so we want to try and get as much value from the hour as we can. So do use the chat box. Tell us if it's making sense. And I'll hand over now to Adam. I know you can expand a little bit on where you've come from and how you trade.
Thank you very much, Simon. So, ladies and gents, I'd really love for this to be as interactive as possible. Okay, Robert, you're saying there's no sound. Just let me check. So, Simon, you can hear me?
Yeah.
Okay, good.
So
Robert,
you won't be able to hear us, but we'll get back in touch with you. He won't be able to even hear us saying this at the moment.
Of course.
But you carry on.
Okay. So I'd love for this to be as interactive as possible. Please, I'm here to answer any questions that you may have to the best of my ability, and hopefully just to kind of satisfy you in that respect. Something else I should bring actually up to my hosts today. Thank you very, very much. And you know what we really need to talk about, I think I would love to do, is a webinar on options trading. If that's something that you were ever interested in, I think we should absolutely have a look at some options trading stuff at some point, because it's such a great opportunity. So very quickly, ladies and gentlemen, there are different ways of obviously approaches, different techniques and ways in which you can earn a well, not just trading is really meant to earn a secondary or primary source of income. Okay, that's really what it is. So it's either there to supplement your monthly income or to replace your monthly income. And then whereas investing is a much more passive activity to build, to hopefully generate wealth and a little bit of a pension or parachute. It certainly is. Next to property, and this is my opinion, they are the two best ways to generate wealth, proper wealth. Obviously, the more you can put into it and the sooner you start, the better it is. But, you know, I'm an example here. This is my second career, and it can be done really well. So today I'm going to cover a couple of things that refer to potentially into portfolio development, building a portfolio, identifying things for a portfolio. In the trading aspect, we're going to talk about reversals, the tools for that. And then also I've got something really cool. If we have time, is I've got the Warren Buffett portfolio from unfortunately prior to their annual meeting, where they removed Blizzard Activision. But it'll give you a good sense. We can go through those individual, instruments or constituents and have a look at them on the chart, so we get a bit of a technical analysis. That's if we have time to do it. So let me carry on. And then options trading. So basically, just to give you a sense of what I do, so that it sort of hopefully makes sense to you. In the morning, I'm usually at my desk at about 6:15, 6:30. My plan is to do day trading. There are two parts of the day being based in the UK where there is a nice potential for moves in the market. I look at the 4 hour for a sense of direction. Is the 4 hour nice and bullish? If it is, then I'm looking for a potential opportunity on the 15 minute. Maybe the 5 minutes, maybe the 1 minute, but it's generally I start with the 15 minutes. And the only reason I would go down to the 5 minutes or 1 minute is that potentially there's a better entry on the lower time frames. And the goal, as you become a master trader, is to try to bring the distance between your entry and your stop loss as close as possible in order to reduce your target. So if you're aiming for 3-to-1 on your average trade, if you can get in on the 5 minute, your 3-to-1 might be 30 pips away, which is great. So if you get in on the 15 minutes, it might be 50 pips away. And so it's always the same direction. It's just whether you can get a better entry. Hopefully that makes sense to you. Then by about 9:30, the market can calm down a little bit, and then it waits for the US session to come online, which is around about 1:30. There can be a nice little surge there where the UK and the US sessions overlap. And then you might take some trades, or maybe not, until about 3 o'clock. In the afternoon, and usually by 5 o'clock you should be done. Then what I will do is at later in the evening, 7 o'clock onwards, is I will look at my daily charts and look for any setups that are setting up on the end of day setup. So I'm basically doing both. There are times when I don't have times to day trade. I can't. I have commitments. So there might be only 2 days in a week where I can day trade, and the rest I can't. So end of day trading is a much easier approach because I only have to look at the daily chart once a day, and it's a 20-minute process, and it can be quite rewarding. And then the stocks portfolio is something that doesn't require daily administration. It simply doesn't. Usually you're looking for signals on the weekly chart, and so I might be adding or removing constituents from my stocks portfolio on an every other month type of basis. Obviously, there are periods like now where a lot of the markets are looking really bullish, where now I'm looking for great entries, but I might also have to wait a week or two to get a better entry, and that's fine because I'm holding those positions for 6 months to 18 months. So the stocks portfolio is there to build your wealth. It's a good thing to do with some of the profits from your trading. Your trading is obviously meant to be there to earn you some income. Now, what are options? Options trading, which is obviously available here as well. Options is a good kind of bread and butter, another way of making money where it's more time-based. So basically, if I have a really nice strong trend and I expect the market has just done a nice swing low and it's going to go up from that point, I can look to, for example, sell a put option with basically what I'm doing is I'm creating an opportunity where I can earn income from as long as price stays above a certain level. I can earn premiums on that. And if I feel the price is going to reverse and is potentially going to cross the line, I can just close out or sell that contract. So it's a different way of doing it. And you can usually only do it when you have the bandwidth, the mental bandwidth. You know, the technical trading is nice and easy. You've got your routine, you can go and do it. But options trading is a phenomenal way, I think, to look at trading. And sometimes it's psychologically easier for some people to do. And it's yeah. So, all right, so that being said, let's move on. So today we're going to talk about reversals. And the idea is two things. One is that the market looks as though it's going to potentially change trend soon. That stops us from getting in with the current trend because it's probably going to change direction. So I want to talk about that because that's something that's, I don't know if it is that way for you, but for many people, including me, it's frustrating that you finally find a great trend, and then when you try to get in, the trend is finished. So I want to look today at what does it look like when a trend is running out of steam, and then what happens is we want the opportunity to perhaps get in on the first few opportunities in a new trend. So that's really what we're going to be doing here, and it doesn't require a lot. It's usually if we can have price. Support resistance levels, price, and the MACD are usually very good, reliable indicators to build a case to take a trade. So here's a couple of things, and some of this is proprietary. I've not seen it anywhere else. It's just me that, as far as I know, that talks about this. So let's talk very much about the angle of momentum. The angle at which a market is moving is also an indication of its momentum. Okay, is also an indication of it. I'm just reading the questions, the Q&A and the chat are open on my right-hand side, by the way. Is also an indication of its momentum. So when a trend starts, it usually has quite a steep angle. This might be after it breaks out of a consolidation, for example, quite a steep angle, very small retracements, very tiny retracements. And then it starts to do slightly deeper retracements, and the moves to the upside are not as big. So the moves start to get slower and slower and slower. The retracements get a little bit deeper. And then it starts producing the new highs that it creates are not really as good. And so once you are aware of this, you start to be able to detect just by looking at price action. And price action is not just a single candlestick. It's usually the sequence of candlesticks, the swing lows and the swing highs. It's the entire, if you think of a candlestick as a word or a letter in a sentence, it's the entire sentence. You're looking at it, you're looking at the angle of it, you're looking at the lows and the highs, you're looking at the collection of candlesticks. You want to put them in context in relation to horizontal levels, okay? Because basically, and this is something that I have more conviction about as time goes by, is that a lot of people believe that your choice is between technical analysis and fundamental analysis. And I'm of the opinion that actually they are the same thing. They are the same thing. They're two sides of the same coin. The charts are merely a printout of the numbers. So if you are looking at a company's profit and loss statement, for example, and you said, can you take this and plot it on a graph for me so I can see what it is, you can see the trend. And that's exactly what we're seeing. So what that means is that as a technical trader, you actually are dealing with fundamental data that's just been printed on the chart, and you're working with that. The beauty, though, is that sometimes when you look at it from a visual perspective, you can see trends or patterns that you can't see, that aren't as obvious when you look at it in a numerical or numbers basis. Okay. And so one of the things that you could see is the angle of momentum. You can see if it shifted, all right, compared to what it is. And this is the beauty. When we bring in the MACD later on, you can use any momentum indicator that you like. If you prefer RSI or you prefer CCI, or you prefer Williams percent R, or you know, something different. If it's a momentum indicator, what it will usually do is detect the speed of the markets, and it's aware, without realizing it, it is aware that the market over the last, you know, 20, 30 candles has changed speed to the previous 20, 30 candles. And it starts to reveal this in the moving averages on that indicator. Now, I recommend the MACD. Why? Well, because it's a very slow moving indicator. It very rarely, if ever, produces false signals. To really hone it down, you could use both the MACD and the RSI. They're both incredibly reliable. If they use this way, they are 90-95% accurate. Okay, and what we're trying to do here is not use an approach or a technique that is a 50-50, which is like a moving average crossover or a histogram, for example. We want to build a case to take a trade where it's 80+% probability that it's going to happen. And so I should also at this time mention head and shoulders patterns. Head and shoulders patterns are they are literally the most reliable patterns that form. They have an 83.04% chance of unfolding. And so if all you ever wanted to do was just trade head and shoulders patterns, which I acknowledge is not super sexy, but it would make money. You'd have, you know, 17 on average, 17 out of 100 trades would lose money, but 83 out of 100 would make money. So if you want to, if your goal is to make money as opposed to make it exciting, you could just focus on head and shoulder patterns and just master those and just make your money there. And you can do that in theory in any market in any time frame. Maybe you'll come away after 1,000 trades and go, you know what, head and shoulders patterns don't work as well in stocks. They work much better in currencies. You know, no one's really done the research on that per se, but that kind of thing could happen. So we get steeper angle and we can see it started to lose momentum. Okay, that's fine. The other thing is when we then look at the candlesticks and we now look at the shape of the candlesticks, so it's price action. You're getting a bit of a price action mini masterclass here. When we look at the shape of them, as the curvature progresses towards exhaustion, we start to get more and more wicks on the candlesticks and more wicks on the top of the candles. And so that's something that starts to show up a lot more. Okay, this often happens as we approach, I'm going to draw something here, as we approach, can I do that? Okay, it's great, it's just the wrong color, that's on me, that's on me. As we approach a major price level, this is something that often happens, and it's logical, it's rational, because as it's approaching that level, all the market does, using gold, for example, is go from $2,000 down to $1,900 or down to the next significant price level. And again, that's driven a lot by fundamental analysis. People look at it and go, I think it's overpriced, or I think it's underpriced at a particular level. So the market will then move from one level to another. And actually, as it does it, traders and investors potentially, depending on the time frame, will be looking to get in or get out of their positions as the market approaches these key levels. So often the market will start to slow down as some of the people who were participating in the move when it was really moving have started to, and the word is extricate themselves. They've started to exit and reduce their exposure in the market and get out of it. And so it starts to slow down because it loses momentum. Sometimes some people will still get in and see if they can get a last bit of that move out. And so it starts to bob around those areas. But here's the point, is that actually it makes sense. You could plot, you know, you can have a level in and watch as the market approaches it, watch it start to potentially slow down. If it doesn't slow down, it could very well then is likely to break through that level and keep going. Then there's a third thing that happens. Okay, a third thing is the colors of the candle start to change. When it's very nice and bullish, logically there are a lot more green bullish candles in the sentence, in the entire sentence of price moving. But actually, as they start to go more to the top, you start to get more indecision candles, and they tend to show up a lot more red. So out of 20 candles, all of a sudden, maybe half of them are red, whereas in the way up, maybe only 3 or 4 of them were red. Okay, so all of that collectively is giving you signals that the market is starting to become exhausted. Is everyone with me so far? Is this useful? Are you finding this helpful? So here's another thing to see it coming to the downside. Now, here's an interesting symptom that might happen for you, is that you get very good at spotting these, but only maybe in a downtrend. Maybe it's very obvious to you in a downtrend, the downtrend is losing steam and it's going to change into a new uptrend. Maybe you spot it to the upside, but the goal ultimately should be to try to spot that in the background. Okay, so again, it's steeper moves, shorter pullbacks, and then they start to do these types of moves. And I'm going to show you these in real time. So we'll go look at some of the Swissy charts that have done this recently and are still doing it potentially. Don't forget, of course, that you start to get more wicks as the brakes start getting put on, and you get more and more green candles towards the bottom. All of those collectively, what will happen is when you look to observe those now, you'll start to visually be able to detect that this is going to turn around. However, the fact that it is slowing down, and this is very important, is not the go-ahead to buy in the other direction. This is important. Traders often make the mistake of shorting the stock market because, or an index, for example, because it starts slowing down. It's also showing some bearish divergence, which we'll have a look at in a moment on the chart. And then they think, I'm going to sell. And they have faith. They believe or they trust that the market is then going to change into a downtrend and they'll be in the money. And excuse me, there's very often cases where the market still does a couple more moves before it then reverses. So it's much, much safer to wait to see the price action, the highs and lows change from an uptrend or a sideways moving market into a downtrend to actually physically show you. So you want to wait for price action to produce that. Okay. So here you can see is what it looks like on a chart. Here you can see we're moving steeper, steeper, steeper. We start forming this. And this is, again, interesting because here is where it starts to form a head and shoulders pattern. So head and shoulders pattern, ladies and gentlemen, is just a change in trend. Okay.
What about time frames, Adam? Did you mention this?
The beauty is this applies on all time frames.
Yeah, all time frames.
All markets, all time frames. I would say, I think because currencies range a lot and because it's always Euro GDP or Euro economy or Euro currency against dollar currency. So it's actually supply and demand of the Euro against supply and demand of the US dollar instead of just supply and demand of one of them, which, for example, gold is or Apple stock or Tesla stock is.
Yeah.
There's a lot more range bound kind of behavior. And so currencies tend to do that a lot more. And so I think that's possible why head and shoulders patterns tend to work up. And when I say head, I'm including, by the way, upside down head and shoulders patterns. Sorry, that looks like a very rude drawing, but I don't mean it to be that way. But yeah, so
I don't know what you're talking about.
So yeah, so these are things.
I have a 13-year-old son, so yeah,
exactly. So you know. So, but here's a point as well: is that yes, we can. I want you to understand as well that there are degrees of entering into the new trend, but that each one carries with it consequences. So the sooner we get in, the higher the risk that maybe the market hasn't yet decided to change direction. And therefore the risk is higher. But the idea is still valid. So it's really about where do we get in, where do we put our stop loss, and there are multiple places we can always put our stop loss. So again, you could potentially consider putting your entry below this and a stop loss above here. But you must always, when you do these types of trades, you should tell yourself, make a note until it's standard for you to think this way, is always say, listen, this trend might not be ready to change direction yet. Usually what we would do as newer traders is wait for price to break, produce a lower high and break that low, for example, then wait for another pullback and then look for that entry. So in other words, it's comfortably shifted into a mode to the other side. Okay, so let's have a look at that. Let's go on to the next things. This is what yep.
When you're trading, Adam, are you using trailing stop losses or?
So I will have an initial stop loss, and the rule that I have adopted from my mentor originally, this is Nick McDonald, was that I don't move my stop loss until I've hit my first target. So I can draw this on the screen now where we are. There's different entries here, and it's a great example of this because when we go to the Swissy charts now, we can see this is going to happen. So I'll use the one on the right, but they're actually the same thing. For example, if I get a nice little double bottom here, so head and shoulders and double bottoms and double tops are two. Double bottoms for me are very obvious to me personally. Like I said to you earlier, that you might find you spot or you're more confident about one pattern versus another. I'm very confident when it comes to double bottoms, not as confident when it comes to double tops for whatever reason. But if I have determined that there is now a double bottom here and this looks very good, I could put my stop loss below these most recent candles or below the lows in total, and I could get in here. But here's the real world problem. It's not an impossible idea. In addition, imagine if my MACD had started going bullish. So we still haven't got to the MACD section yet. But when I talk about this, my MACD has started to trend higher. And right now my trend has started to slow down. We've got bullish candles over here. And so the idea is, you know what it is? It's premature. it's valid, but it's premature because there's no change in trend yet. We're still in a downtrend. We still have a series of lower highs. Does this make sense so far? Is everyone following me when I say this? And so I see what I'm seeing is what I think of as a double bottom, very nice little wicks over here off a key level, and the MACD is nice and bullish. So my brain is thinking, you know what, this is going to change trend in the near future, and therefore I could potentially get in above the high here, stop loss below the here or below there, and those are both valid places to put my stop loss. But it is premature because we haven't got that confirmed change of trend. Then there's another second, the next point at which I could possibly get in is if I have an entry above the high of these highs here and price breaks above it. That becomes now what's happening is we have a brand new high. So the market has gone from doing lower highs to higher highs. And so you could argue that that becomes the second best entry. If this is the sooner one, but the most premature, this is less premature. And because it breaks the high. So now we've got that extra, if you imagine a series of boxes being ticked that make it safer and are extra degrees of confirmation that the trend is changing. That becomes the second one. The third one, which now I actually think, so imagine these are higher risk premature entries. The idea is still the same. Then the next one that comes back is the market will very often do this. It'll break a high, come back, test it, and carry on. So that becomes the valid one. And that's actually this little one over here. And so what I'm looking for is when price comes back to the previous highs and produces, I'm looking for it to produce a bullish candle. So bullish candle is nice and green, nice full-bodied, or a nice rejection wick on the underside of it. And that's the idea that the buyers are coming in and they've determined at that key level, they are probably going to step in. So then my entry can be set above the high of the candle with my stop loss below the low of the candle or below the swing low here. Now, the interesting thing about this is that that entry might be very, very similar to where the break of the high is, but it's actually a little bit safer because you've got one little bit more bit of extra information to that. And then if the market takes off, again, I could put my stop loss below that. I could put it below these lows here and right at the bottom. So I've got various places I can put it. But again, where you put your stop loss and where you get in, they all have consequences. It's not healthy to think of, well, the one way is the best and the other way isn't, because some will suit some people more. They want a wider stop loss because it stresses them out with their stop losses too close. But there are consequences. The further away your stop loss, the further away your target. So in answer to your question, Simon, sorry to come back to it like this, but you said to me kind of what do you do in terms of a trailing stop loss is I don't move my stop loss until I've hit my first target. So if my entry is above the high of this candle, my stop loss is here, my first target is 121. So this distance from my entry to my stop loss is known as 1R because that risk amount will vary. It will be 1% for some people, 0.5% for others, maybe 2% for some people. So it'll be known as 1R. And therefore, I won't take any profits or move my stop loss until I'm at least up 1% in profit. And then I can take some profit off the table and I am, and then I've got a break-even trade. Then I can move my stop loss. Usually what I will do is wait for price to produce a higher low and then move my stop loss. Oh, there we go. So one time I found this feature to be useful is now I can actually move that stop loss below the next higher low. And then I can trail it that way. And here's the thing though, the problem with trailing stop losses, if your only method to capture profit is to use a trailing stop loss, there's a problem with it. From experience, from results, trading performance results, is that usually the logic, the rationale to use a trailing stop loss, it's often driven by greed. The idea is, well, if this move keeps going, I want to keep getting profits from it. But the fact of the matter is that you're always going to get stopped out when price comes back, which means you're always going to be giving back a chunk of the profits that you see. So you're never really going to get the profits you think you are. You're always going to get less than that. And so usually what happens is traders will target 3-to-1 or 4-to-1 or where the next major level is, but 3-to-1 is the go-to daily targets on trend-based targets. It's a very sensible approach, taking partial profits off at 1-to-1, targeting 3-to-1. That way, if there's a massive spike in the market, all of a sudden, you will get closed out in profit. If you use the trailing stop, what will happen is after there's a big spike, the market will often come back. It might even come back all the way and just close you out. And so you maybe get out at break even or 1% when you could have got out at 3% or more. So that's practical experience. Ask yourself why you want to. My logic is to use both. So I've got a target, which is usually at the next major price level, and I've got something coming from behind. So I don't trust the market to be kind to me. I'm saying there could be a nice spike in my favor, or it could move slowly, or it could reverse. And if it reverses, I want to capture it from behind. So then I've got the trailing stop losses. Okay. So to carry on with this example about where we can get in, the next spot that most newer traders will wait for is the brand new high. So price, I'm going to go and clean it up a little bit. So my very first one would be, sorry, what are you doing here? This is a bit annoying. There we go. Sorry about that. So my very first entry. Yep.
Just because we've had about sort of twice as many people just arrived just in the last sort of 10, 15 minutes, just to say welcome to you if you're just joining us in the last 10 minutes. I hope this is making sense. I know you maybe missed the start, but it is recorded, and we'll have a copy that's on the Fineco website in probably just a few days. Adam Harris is the speaker today. He's taking us through the technical trends and we're looking for reversals and understanding the signals that we can get. I'm Simon from Round the Clock Trader. It's good to have you here, but please don't be shy to ask us any questions. Adam and I are happy to help with any questions, anything that just even let us know that it's making sense to you. There's a chat box just on the right hand side of the screen, so don't be shy. Thank you, Adam. Sorry.
Okay. So so my first potential entry would be the double bottom. My next potential entry might be on a break above the high. My third potential entry would be on a pullback, and each one has greater degrees of confirmation, a little bit more confidence. The final one, which I think and is very acceptable, by the way, is waiting for price to really give you a confirmed uptrend. So again, sorry, it's not even the final one. You can get on a break above that high if you want. I'm going to talk about entries at the moment, or you could wait for a very first pullback to get in here. So there are multiple entries along the way, and that's a key point of today's topic, is where are those entries, why each one is valid, but why there are consequences to each one. And at which point you are more on the safe side as potentially this very first pullback or this. Now, here's something really interesting that sometimes you have an obvious, in hindsight, conceptual breakthrough, but your brain didn't get there. Should have got there much sooner, but didn't. But here's the thing: every entry into a trade is either a breakthrough, a breakout, or breakthrough, or a pullback. That's it. So if price is moving up, you either get in on price breaking out above that old high, or you're getting in on a pullback. Okay, those are your only two ways to get into a trade, as far as I'm aware of, which I find quite interesting. Which means that on all of these moves here, you can do that. And getting in on a break of a new high. So, for example, occasionally you'll get Simon has another phenomenal stock trader as well. Zahir, his stuff, he really likes breaks of new highs. That's a big thing. He's a big fan of that, and it's a very valid way of getting in. My preference, wherever possible, is to get in on a pullback, looking for that sweet spot where prices pull back into the moving averages. Now, occasionally they overlap. Believe it or not, price is ping-ponging right below the surface in the moving averages, and there's a pullback just ahead of a breakout, and you can get in on either, and the difference won't be that much. So the point is that we're looking for either of these. I would say to you, working backwards, the pullback to here is usually going to be the most common one for most traders. By that time, you have got a confirmed uptrend, and your very first pullback on an uptrend, which is from here to there, to there, to there, and pullback. And therefore, that becomes the safest, very first opportunity that you want. Now, if you follow Elliott wave theory, which I don't think is necessary, it goes with, 3-wave and a 2-wave pullback, blah, blah, blah. But actually, then what happens in that situation is you're still usually getting at least the concern is that the most juice in a move is in the first part of it. Sorry, I don't mean to be shouting. You don't need to hear me shouting. I just get excited. Whereas, and the last third is, the last third. So that kind of thing can be self-reinforcing. You can see there's a bit of a 3 sort of move here. I don't want you to think about that too much. I just want you to think that, the earliest move is the highest risk one, the most uncertain one. The second move is usually the sweet spot. And the third one, trends can carry on lots of times after that. But if you have a common sense approach that, yep, once we hit the third move, then the risk of the trend running out of steam is higher. Then just have that kind of approach, more common sense approach. So,
sorry,
question, I got it.
Yeah. Can I just there's a mix of people here on the webinar. I know there's some Marzenna, John, you're probably quite experienced, but for those of you that are beginners, is this something that you would eventually become sort of a second nature? When you look at the charts, when you're day trading, this kind of thing starts to become something you don't, because what we're learning here is fantastic. You're learning, but you're taking through very slow, step by step.
So yeah, it's like the best analogy I can think of is driving. When you're driving a car, when you first get started, checking your blind spots and remembering to use your indicator and put your seatbelt in and change gears. It's very kind of like it's too much stuff to do. But after a while, you do it completely unconsciously. Trading is very much the same thing. You've got so much information in the beginning to absorb. What you don't realize is that a lot of it is ultimately becoming muscle memory. And then after a while, you can look at a chart and in seconds you can assess what's going on. But in the beginning, you really have to process it, and it's exhausting.
But for that to work, would you recommend it's better to stick to just one or two different strategies and become accomplished at that, rather than swapping your strategies?
Oh, wow, absolutely, because it's hard. The desire to play, to tinker, to change strategies, and somebody else's on Instagram or something's raving about how their process works and Fibonacci levels and pivot levels, and sure, but the 100 trade challenge, pick one way of doing it, ideally with a trend would be my number one recommendation, trading with the trend. Small amounts for your first 100 trades, 0.25% to 0.5% maximum per trade. And your focus then is not at all about the money, it's on the swing, getting your technique in place. What will happen during that period? Your ability to identify the pattern will improve. That means that just within 10, you need to get trades under your belt. You need to, and your first few trades, your first 20 or 30 are going to be crappy, terrible, losing trades, because your ability to identify those patterns is not strong yet. But the fastest way, it's counterintuitive. The fastest way for you to go from, it's a hare versus tortoise thing, to go from being completely not knowing anything to knowing with confidence that a system works and that you can always fall back on that to make money, is to just knuckle down and just commit to the one as an example, and to just do that. And small amounts will keep your emotions in check. So the number one key, the number one solution to trader psychology is just small amounts. 0.3% every day in your accounts will compound to 6% a month, which will compound to 100% a year. So small amounts will get you, ironically, where you want to go without you losing your mortgage on your house and the credit card debts and all kinds of things. And that's just a whole world of pain that people weirdly will opt into. And if I can spare you from doing that just by reminding you it isn't necessary and you're willingly exposing yourself to danger. So your first few trades are going to be big losers, and you want to learn that pattern. And after a while, your confidence and your belief and your skills and your technical skills and your mindset, or it's a wax on, wax off thing. You don't realize the progress that all those different aspects of you will make just by doing a 100 trade challenge on a single strategy.
Does that sound familiar to some of the more experienced traders we've got here in the room? Luis is saying, so is trading a couple of days per week a good strategy for someone doing it part-time alongside a day job? Would you say?
Yeah, my mentor Nick used to trade the US Open as well. So he'd find during his lunch break, it would tie up at the US Open, and then he'd trade that. I think he was working at Citibank at the time, and he was just trading for himself. He really liked doing that. So he would trade with the trend, looking to close the gap. If you got a new uptrend, he would then look to target the gap, for example. And that was definitely one way of doing it. So I don't think there's an unlimited number of ways of doing it, but I think that there's 10, 20, 30 different ways of which we can do. And if we decide to just trade with the trend, I think that's a good approach. So trading, for example, as I said at the start, which you might have missed, is that every day from Monday to Friday, every day from about 6:30 to 8:30 p.m., I look at the daily chart and I'm looking for the end of day setups. And that's because sometimes day trading is not enough. I don't have that opportunity. This week, for example, Wednesday and Tuesday and Monday were just chaos up until about 2 p.m. So I just didn't really get the chance to do that. I do think day trading is great. My time frame is about, the big moves will tend to happen somewhere between, say, 7:30 and 9:30 a.m. And then nothing will really happen until the US Open. So And that's kind of it. So that actually means that a lot of times waiting for trades between 10 and 12 is not a fruitful technique. And after 3 p.m., it's not that fruitful generally. Then you might as well just switch to end of day trading. So, okay, I just want to carry on here quickly and just show that when we, the market structure is really important. When we have these lower highs, that's because the sellers are in control. Now, remember, they don't know they're in control. It's a cause versus effect thing. They, some people have to sell for whatever reasons, and then as it's unfolding, you can kind of detect, okay, the price action's failing, and then you might decide to get in on a sell, and then that compounds and that adds to it. But what is important is that at some point, if price breaks the previous high, this is usually an indication that this lifespan, this part of the lifespan of price action is over. That downtrend is done. Same thing in an uptrend. And this is why we often want to put our stop loss behind these swing lows, so that if price does manage to breach it, that's usually a confirmation that it's not going to go our way. And here you can kind of see how we switch from a downtrend of lower highs, then we break into an uptrend. And interestingly, here we get an uptrend before we break the previous high. We turn into an uptrend, nice little breakout there. Beautiful that it's a little bit of flat level breakout. Price breaks out, then it doesn't move up. So there's your uptrend. And you, at most, would have got a chunk of this. You can't capture every pip of every move. It's impossible. Nobody does it. Nobody can do it. What you can do is capture 50% or maybe as much as 80% of a move on your best days, on your best trades. And that's more than enough. If you can get 30% of a move because maybe there's a trend that kicked off when you were asleep at 2 in the morning and you only see it at 6 and you get the last part of that trend, that's also very acceptable. Then you can see it moves straight into a downtrend, then it double bottoms, then it breaks above that, and then it continues up and you're in an uptrend. So the market becomes a lot. What happens is over time is your brain starts to really just simplify all the craziness in the chart into very core, simple moves. And that will come a time. And unfortunately, I don't think you can bypass that. I think you have to have the data before your brain can see these are the patterns that reoccur in the data. Okay, so you've just said here that tops and bottoms are dangerous. Can you explain a bit more on that? Just expand a bit more on that, why they're dangerous or where the concern is with that? Because yes, there's for example, there's that expression of trying to pick tops and bottoms. Mm-hmm. But what we're doing here is we are identifying patterns that only occur at tops and bottoms, and we're waiting for them to confirm before we potentially take a position the other way. Okay, so again here you can see that shift from a downtrend into an uptrend, and there's your double bottom, and we've got that change in trend. So I'm talking really here a lot about waiting for that trend to change, so that you get that confirmation before you consider going the other way. And again, here you can see this is a downtrend. Price might even come up and double top it, then come down, produce a high low and break it. And so this is the point at which you get that confirmed sentiment shift to the upside. And it can happen different ways. So in this case, we actually got price pulled all the way back up to the previous high, then produced a high low and then broke. So there's your confirmed uptrend. Versus in this case, we had just a lower high and then a high low that went straight into that. So those are like the only two ways that can kind of happen. There'll be variations of that, but yeah. And the same thing to the upside. Here we get that shift and it's a head and shoulders pattern. But whichever works for you, think of it as a head and shoulders pattern or a shift in trend, whichever happens to you. And that's why we can look for these various entries into that, okay? And then it can get more complicated. If you want to focus on price action, when price starts to break across that line, maybe that's on the daily, maybe someone or the 4 hourly, then someone will go straight to the 15 minutes and then look for a little bit of a retest on the lower time frame. So then they go, okay, I'm looking for a little bit of a retest and I'm going to take that on the 15 minutes. But the concept, the idea, the trade idea is always formed that way. Yeah, absolutely. So thanks, Robert. Yeah, you're talking about tops and bottoms are dangerous because of getting in too early on the trade. And yeah, I want to let me repeat what I said earlier because that should sync up with this, is that the idea of it turning, if you see the evidence, the bearish divergence and so on, it's all a great idea. But if you have to understand that the sooner you attempt to do it while not waiting for the market price action to confirm that, the higher the risk. Okay, you might not be wrong, but the risk is there. So let's quickly talk about the MACD. I want to go to the charts. I want to talk about a few of these things on the platform as well. I want to show you on the platform. So basically, the looking at momentum on the MACD, for example, we're going to go with the MACD today. If the market is producing high lows and high highs, and the MACD is producing high lows and high highs, it's bullish. So there's no signs of exhaustion there. There's no reason why the trend should change. They support each other. When there's disagreement, we call that divergence. So that means the price is producing fresh highs, but the indicator is producing fresh lows instead. That's a very reliable indicator that the market is exhausted. It's not an indicator to buy, to sell, or take a position the other way, because again, that would be picking tops or bottoms. It's the same problem. But it should, what it should do is tell you that the market is going to, the price action should then shift direction. So when we have a few of these, for example, we can see these were taken from the other platform in the past. We can see here that that would be bullish and that's bearish, and this is now bearish and bullish. We can see that it's trending higher. And this is very, very reliable when we use it this way. From the platform as well, we did this in the past. It was very cool. We've got a MACD trending higher. It doesn't matter which moving averages we use because they're both going in the same direction. So whichever one you pick, it's going to be trending higher. It doesn't matter. And you can see here we've got fresh highs. You can start to see bearish rejection candles coming in. But overall, this is nice and healthy. So when we get this, what does it mean? It means that when we get a pullback into the moving averages, it should statistically mean that it's safe to take another buy position if we see another buy opportunity. And the trend should keep going, if for nothing else, for one more move. And this is what is a big difference between trading and investing, is trading is really looking to find a setup where the market is signaling that its very next move, where its very next move is likely to go. That's it. Trading is not about trying to guess where the market's going to be 6 months from now at all. That's investing. Trading is about where the markets are likely to go from here with all this evidence. Okay, cool. So, and we had some really good ones here. Here, for example, the market's going flat, but this bearish divergence is trending lower. So the indicator is bearish, which means that price is likely to fail to break through and potentially could change trend and go down. I would wait for that before I start shorting those opportunities. And so here you start to see it. You've got some really nice equal highs or higher highs here. The indicator's gone bearish. Then it breaks through these lows. So here's what I'm going to do. I want to just reduce the thickness. Oh, I can't really do that. Okay, that's fine. Pencil tool. So there's a level of support here. You can see resistance becomes support here. Price breaks through that, then comes back and produces a lower high. So that's not only has it broken these previous lows, that's very significant. So in other words, we see the bearish divergence, then we see that, then we see price action break this low. But then it comes back up and it comes back into that low, it produces a lower high, breaks that low and goes into a downtrend. So that's really nice. That's actually where we get the correction. Then we can see that actually it starts to trend higher again. We've got price producing high lows and high highs here. We get an equal high. We get bearish divergence there. We do the same thing, ladies and gentlemen. We break these lows. We come back into that and produce a lower high and break that low. So the behavior is exactly the same in these cases. And the entry points, depending on the degree of risk, is either as we go through that level, so let's move it, it's either as we kind of break through the low or get the pullback. Both of those are valid. They are just up to you which one you prefer. You can't necessarily know that until you've tried them all, and then you realize, you know what, I tend to, sometimes the one that makes you money is the one you don't care about, strangely enough. In other words, sometimes the one that you perform best with is the one you're less emotionally invested in, that's less exciting to you. When we get excited, we tend to make bad mistakes. Our judgment can kind of drop. So, this is all very much the same type of idea, which I think you have got. Let's go to the platform. This one and here. Let's go look at the platform here. So what do we see here? This is super convenient. This was not intended. Let's have a look at the story here. Nice little uptrend here. We have got, there's no doubt that we've got highs here. There's also some exhaustion on that one. Let's see if potentially there is a nice little flat level here. That should be Alt O. And so we've got a nice little level there of resistance. We can see that depletion, exhaustion, and we get, and this is a new thing, by the way, this is a momentum candle. So the momentum candle is when market hasn't been going in area for a while, and then you get you get a candle that just boosts its way out of that position. It's very, very nice. It usually helps to get it. Even here, for example, there's a little flat bit of consolidation. We've got high lows. That's a flat level breakout. And here it failed to break up, but here that momentum candle took the shot and then eventually got out of it. Here as well, you can see again, we've got this whole area here where price is ping-ponging in a range, and then this candle bursts away from that sideways price action and closes beyond it. And that's just a nice indication that that consolidation is done. So what do we see here? We can see definitely that the MACD is trending lower. We can also see we now have a slightly lower high. So when we break through this level, that would be an example potentially of price breaking through, possible entry on the low of that, or a pullback, and then the very first shot to the downside. Okay, and by that time, the MACD is also trending lower, price action is trending lower, and that's a straightforward shot. Okay. Then what did I want to talk to you about? So dollar Swissy is great. This is one that's definitely there because this makes a lot of sense to me. So Alt O, it's my horizontal line. Boom. Let's go do this one. I can just move this up a little bit. That's not bad. So again, we've got that bullish divergence. So remember, you don't really know that. And some of them are very obvious and some aren't. So here I noticed we had the market attempted to double bottom, came back up. There's actually another equal high. So it did try to turn around, but it couldn't. And then it did another move down. And then actually that's when it managed to succeed in breaking up. So then what does it do? It comes back to these highs here, comes back to that, and then manages to break out, not very successfully, but there it does it. So there it's a fail breakup, but then it just keeps going. An attempt to break out. So there's a whole lot to happen now. We've got a bullish MACD. We've got this attempt to turn around. We've broken above the previous highs. So I don't think there was anything here that was a really great entry. Nothing. What would I have liked to see? A really bullish candle. This kind of failure is not great. And again, you'll get a feeling after a while that's a strong signal. There'll be times when it doesn't feel as strong. And we can see price breaking out. So what am I looking for here? Ladies and gentlemen, I'm looking for the very first pullback to this high. Does that make sense to you? I'm looking for the very first pullback to this. I've got all the other things that have happened. I've got that change in trend. We've broken the previous highs. We've got a bullish indicator here. I need the first pullback, which will be the first high low. So let's see what happens. Okay, we haven't got it yet. Okay, so in this, I've taken the trade. I attempted here on the double bottom. I got stopped out. So that was the earliest thing. And this, again, I want to repeat. That was a choice I made. It is a higher risk. And I don't believe it's higher reward. It's just a higher risk setup. It's not higher reward. If the market goes from there, I make money. If it stops me out and goes, I've got to get in again anyway. So I don't think it's a smarter move. It's just that if I see the setup, I can take it. So I'm trying to emphasize here that there are techniques that I think are better for newer traders, and sometimes because and to get rid of that myth that because it's an earlier entry, it's high reward. It's not. It's higher risk. That's all. Okay, so that looks really good. And so where it gets interesting is we start to look at some of the other Swissy pairs, and this is a magic thing that's not in the slide deck, is correlation. So I'm just going to run through a couple of these to see what some of them look like. Do they have similar types of patterns? When we look at this one, not really offering a lot right now, but it is in an uptrend. Okay, so let's look at Aussie Swissy. Is there anything there? You can see it's also trying to turn around here. Very nice downtrend. We've come up to these highs here. Okay, so we've come into a previous level of that. We're trying to produce a high low. We definitely have a bit of a double bottom here. That's a much stronger signal. And you can see it's now starting to trend higher. So yes, you could enter on a break above this high, or you could wait for a break above and a pullback. Also, sometimes a break on the high and maybe it hits your one target, so now you've got a break-even trade. So when it pulls back, you can get a new re-entry into the trend if it still matches your trading strategy. What about, what was the other one I saw, which was, interesting. I'm not seeing CAD Swissy here. Okay, so that's fine. Let's have a look and see. Oh, there it is. My bad. Okay, CAD Swissy has done it. It has broken this previous high. It has confirmed an uptrend. Yesterday, it broke this high. So you've got a confirmed uptrend. You've got a previous break of a high, and you've got definite bullish indicator. So I'm in on CAD Swissy. As far as I know, I'm in on that. Very nice. And this is because the daily is heading higher, and I believe there's a good chance it could head up to here. That actually means, in a way, I might be able to do day trading on this. So how would I do that? Let's go down to the 4 hour. Now, all I want to do is make sure that I'm not getting in when it's overextended on the 4 hour. But the logic is it should continue up. And there's actually a pretty nice trade. You can see the 4 hours started to go away from the moving averages. It's not overextended. If we look at previous moves, this kind of a distance from the moving averages, that distance from the moving averages would be overextended. It's not really that overextended. So I quite like the look of it. MACD is trending higher. This looks good. The daily is good. The 4 hourly is good. So let me go down to the 1 hour or the 2 hour. Let's have a look at that. So the 1 hour has just had a bit of a consolidation breakout. and it's now at a bit of a pullback, and it's now trying to go. So this is not a trade recommendation at all, but just what's interesting here is a break of the high with a stop loss below that low or that low could potentially be argued. It's not a fantastic entry, but it could be argued as a valid trade idea. And then you need to know where your next few levels are. There's 0.67. Maybe there's, got to make sure I can get in. I could try something different. If I'm nervous about this, I could go down to that 15 minutes and wait for the very next pullback potentially. Here you can see it's trending higher, MACD is trending higher, momentum is good. That's fine. I suspect what will happen is maybe during the US session, it'll pick up pace. Okay, so keeping an eye on the time because we've got 5 minutes left and I might run over by a couple of minutes, but I'm trying to finish on time here is, excuse me, what's your Aussie doing? Okay, so your Aussie's been trending higher on the daily. Again, although we've got a lower high, it's not a really strong one. I'd wait for a break of this low. You can see though that the MACD has generally been trending lower. So my expectation is that there's a good chance that this could change direction, and I'm absolutely not going to take any positions on it until I do get that confirmed change in direction. And so if we go ahead, and so one of the ones that I wanted to show you, which is amazing, is let's switch this up and go have a look at, let's go look at, I just moved this to the right. Let's go here. What do I want? I want CFDs.
This is the new platform, Adam, isn't it? The new Fineco X platform, which just launched a few months ago.
Yeah. So yeah, it's much more intuitive. It's very fast, lightning fast. So yeah, that's good. So let's go and have a look at the S&P. The S&P is a fantastic global barometer of what's going on. Can I do a quick survey? Who thinks the US is going to default on their debt? I'm curious. Who thinks that they're going to default on their debt? No judgment, just curious, because they certainly are marketing it. This is a breakout, by the way. This is a beautiful breakout happening soon. This is a breakout setup. There's some concerns here, so let me talk about this as well. The price action is wanting to break out of this flat level. It definitely wants to do that, but the MACD is wobbling a bit. You've got flat price levels in this area, and the MACD is starting to level out, so it could be looking good. But that is going to be a likely breakout move. I quite like that. It's obvious to me now, but that's because I've looked at 1,000 breakouts. This is desperate to break out. It might break out today or tomorrow. So anyone have an opinion on whether the US is going to default on their debt? So the US dollar is the world's reserve currency. Because we've had Brexit happen, let me explain a few things. And it's my personal opinion. Brexit was a nightmare. We're still trying to get ourselves out of that whole thing. So if the countries wanted to move away from the US dollar, it would take 10 times as long, 10 times more complicated, 10 times as long. So that's the first thing. The second thing is you'd have to move away to another reserve currency that everybody else believes equally has agreed to. So in other words, it has to be by consensus. Right now, there's just no, and it has to offer benefits that you just don't get or that you're not getting here. It's not enough to go, well, I'm worried about this. That's not enough. You have to have visible benefits to shifting to that. We also live in a very unique time where globally, democracy versus autocracy is kind of in the balance. So it's not even about the small stuff anymore. It's like either you want pro-democracy or you're not. And that is likely to impact whether someone decides to shift. And languages, it's all English at the moment, English being the sort of most widely spoken language, I think, on the planet. I could be wrong about that. I could be. So there's just a lot of reasons why it would just not, I just think it's not possible in the next 10, 15 years that maybe the conversation will be there, but that actions are actually taken on it. So I think there's no reason to do it. And therefore, I don't think we'd ever move away from the US dollar, possibly not even in our lifetimes. And there's certainly nothing to worry about right now. The second thing is defaulting on the debt. And this is my personal opinion, absolutely will not happen. Of course, there's a possibility it could happen. I don't think it's going to. I don't think it's going to remotely. And my number one reason for this is they don't have to. It's not like they don't have the cash or they don't have to do it. They can completely pay their debts. They can do it. And the consequences of not doing it are absolutely insane. So it will happen. My understanding is that the current administration believes in paying their debts. They believe in doing it. So they will not default. At the same time, the reason they're even having these discussions is because one party is trying to negotiate, not agreeing to do it, so that they can get 85% of their agreements can go towards the oil industry, benefits towards the oil industry, and so they can get bigger salaries. That's essentially what's going on. So I don't think that's going to happen. I don't think people need to stress about it. I believe it's a manufactured crisis where we know the outcome already, but the drama in the run-up to it is something crazy. So I wanted to show you this. The next thing I want to show you this is, so the S&P is looking really good, and that breakout could be triggered by the news that they found a solution. Could it happen that they default on their debts? The consequence of that would be nightmare for everybody, including the US, and they don't even have to do it, which means it would be self-sabotage. It's absolutely bizarre. It doesn't make sense to me. I want to show you the NASDAQ. The NASDAQ took the biggest hit, and we're going to wrap up after this, but it took the biggest hit. I'm going to have to do the Warren Buffett thing after a while. Maybe if you give me 2 minutes, I can show you a couple of them. But this is beautiful, and you can see again, we've shifted into a much more bullish mode. The NASDAQ, which had the most growth in the last 10 years, had the biggest correction. It's now started to move. It's looking very, very bullish, very happy about that. And specifically, one of my absolute favorites in this is going to be, this is a personal thing. Again, please, it's not a recommendation. I really like the look of this one. And it was one that I was the most worried about. And I just really, really enjoy the look of Amazon. It started to become incredibly bullish. And this becomes very obvious when we look at the weekly. The weekly is what offers those clues. It's just trending beautifully. It's above the 50-period moving average. 10 and 20 of reorder. Those are all little things that just bullish, 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 bullish. So it's a fantastic, fantastic one. Even Kathy Wood's ARK is starting to show some really good signs. PayPal's the only one that's struggling quite a bit. Yeah, and so those are very, very interesting things. So if you can give me 1 more minute, we can have a look at this. So this is Buffett's stock portfolio. As we go through this is that, and there's the list of the different ones. And I'm going to pick a couple from this, okay? So I'm going to go to, I have to wait for this to move along. So I'm going to move this to the end over here. And then I want to move the platform to the end as well, because there's a thing on my window that gets in the way. So one of the ones I'm going to have a look at, we'll go have a look at Apple so that we can do this. So first of all, tech stock's doing very well. Let's take a look at Apple on the weekly. Looks good. Very nice. Back up at all-time highs. Very nice and bullish. And it's not just that. The price action's stable. That's fantastic. I like that as well. So the question or the comment is, I tend to set appropriate levels on my weekly charts. I agree with you. I think because I trade the daily chart just moves between weekly levels. So that's why for me, weekly levels at a minimum are very, very, very cool. I always appreciate your comments, Robert. Please keep them coming. I always appreciate them. Okay, then Costco. Costco is usually a very stable one. Let's have a look at it. So this is one of Buffett's as well, but historically it's incredibly stable. It had a real boom. Costco will do well because people cut costs when there's a recession or there's keeping their costs low or inflation, and that's it. So they'll actually grow during a recession. That makes them pretty cool. Look at the MACD trending higher. So the MACD is trending higher, but price is not creating fresh highs. Some people might call that a hidden divergence, but it's actually bullish. The fact of the matter is the indicator is bullish. Price is forming a very, very narrow wedge. I think there's a greater chance it's going to break out to the upside than anything else. And that's all I mean. And then finally, let's have a look at something else. So let's show you something where it doesn't look cool. Something else on the list where I'm not as impressed. Some of these were sort of a little bit, I find something that just doesn't look.
We're going into fundamentals next month, aren't we? On the next webinar.
Yeah, we should do that. And I think we should also, I was just going to find something else on this list. So if you go through the charts, and what I'm really doing is looking for stuff that has a historically nice, stable trend. If you look at a few other things, I'll just find something else where maybe it doesn't look like that. BP or Shell are also good examples of that. You can see in general that looks good. What about Baker Hughes? Just running through them to find something. This one. Okay, so this one doesn't perform necessarily as well as the rest. So you want to watch your exposure in tech stocks. You want to, so in other words, so that you're not doubling up on that. But at the same time, so my investing is very much influenced by value investing by Warren Buffett, but then I've got that layer of technical analysis. So I'll look for the stuff with the best trends, where the trend is very nice and it's going higher. A lot of analysts will promote to their clients stocks that have been trending down for 5 years and tell them, this is so cheap now, you'd be silly not to buy it. And my logic is always, but it's trending down for 5 years. I want something that's trending up. That has to be surely a minimum requirement, is to get that reversal. Because remember, we're talking about reversals here as well. So you can get a nice gold had a fantastic one. Last thing I'll show you, because I know we're just in the questions phase now, guys. We're 3 minutes over and I want to wrap this up. So any other questions you have, please don't be shy, ask those. But let's go ahead and have a look at CFDs on gold. I want to show you gold's one at the moment. So let's just see where we are with this one. Okay, gold is looking very bearish. Just looking at it now on a weekly basis, look at that exhaustion at that area. Gold has tried, and it's failing. So it looks like we're getting that momentum candle to the downside, which implies that gold has not finished with its move lower, that it's still got some potential to go lower. I was looking for a better version of this if I can, maybe in the futures options. CME. Haven't got anything on gold here. Have we only got it through CFDs? I'm surprised. Okay. Shares, commodities. Would you have it under Forex? Would you have it there as XAU? No. Okay, ladies and gents, I'm just going to have to leave that then. I wanted to show you this. But again, if we go and move this down to daily, very quickly, we can talk about what is the state of it right now. You can see doesn't show much bearish divergence. We don't have enough data on this. Sorry about that. We've broken that low. So I'd look for a lower high and a continuation lower on the daily. I think we're likely to see the gold go down just for a few more weeks, possibly, or possibly a couple of months. Okay, so any questions while we wrap up on that? I wanted to, so yes, those, the changes in trends, the price action, what we see in the candles off key levels, combined with the MACD, combined with breaks of previous highs, pullbacks, those are all things that have to happen in order for a trend to change. And then you get your degrees of where you want to get in, where you want to put your stop losses. So I do appreciate that there's a lot of information that has been dropped onto you in the session. I know it's being recorded. If you give me a copy, and if Fineco is okay with this, I'll post it on my YouTube channel as well. I'm very happy to repost it so that it gets distribution and put it on LinkedIn and spread the word. It's up to you guys.
Oh yes, we can talk about that with the office and let you know.
Yeah, thank you. I'll just give me a high quality recording.
A question about the US public debt issue, but we covered that already.
Yeah.
So I mean, you have the opinion like me, it's not going to happen. I think people just like theorizing how financial crashes and
it's a lot of drama. The news channels feed off it. I'm starting to realize how much they love that. And the key thing to remember is that they don't have to default on it. They can, it's an option. So, and that's a very, like, they have the choice. Whereas some people, if you're in debt and you have to default because you broke, but they're not. So US is doing fine. But there's a lot of drama at the moment and a lot of propaganda. So I would be very cautious on it. Everything is looking, markets are looking, can I say this last thing, ladies and gents? The markets are looking good. I realize that with all the very negative, scary stuff we hear, I'm just saying technically, the markets think they're in a bull market, and if you think about it, it's that you don't get a clear signal when the market's turning around. When it's at the beginning, at the bottom parts of it after a correction, people are very cautious to say it's in a bull market. I'm saying technically it is ticked the boxes, it has crossed the moving averages, produced the high lows on those weekly timeframes that qualify it as going into a bull market. Inflation is largely under control right now. A lot of that inflation is still sitting with companies that are getting profits from hiking their prices. They could be cheaper. They're opting not to, because during COVID, people saved a lot of money and now they're spending their money, but they're spending their savings. And when they run out of savings because the prices are high, like travel's ridiculous and so on and so forth. Don't forget the airlines got bailed out and now they're squeezing people for money. So let's be clear, they are doing okay, but the market the stock market at any rate is bullish. Nikkei is on fire. It's been going in a downtrend for a couple of years. It's now fully uptrend, racing towards its old highs. And so that was like the last one of the bunch. It looks fantastic. Maybe got to look at Hong Kong as well, HK. But yeah, so I'm just saying, technically the markets think it's a bull market right now.
Final question, Adam. Thanks. It's been a great presentation, by the way. Just to go back to the reversals and spotting the turning points. on timeframes. Was there a preferred timeframe that you feel that works best in, or do these models that you showed us work on?
Again, yeah. So the 4 hour, 1 hour, 15 minutes, and the daily, all of those are very good. I'm a little bit more cautious when I see bullish to bearish reversals on stocks, because the best stocks tend to continue going higher. They're very reluctant to go lower, and indices. That's it. Otherwise, on commodities and on currencies, going from bullish to bearish and head and shoulder stuff is very strong. And certainly, I find turning around and becoming bullish is very reliable. Those ones, yeah.
Fabulous. Marzen, a wonderful presentation, Adam. I couldn't agree more. Fantastic stuff today. Thank you so much for walking us through that. Thank you, everybody here that's attended us this morning. Have a great day. Thank you to Fineco for hosting us as well.
Yeah,
and don't forget, if you're not yet a customer of Fineco, all the platform and the data that you've been looking at, the charting tools, that's all included in your free Fineco account alongside your current account and debit cards and things. It's a great package. We posted, I think, the link, didn't we, in the chat earlier on. If you want to find out a bit more about what's on offer at Fineco, you just use this link to request a demo, and you can get started straight away. So I'll post that again for everybody there. So thanks. We're back again.
Thanks, Marzina.
21st of June. Adam, we're going to be looking more at stocks next month.
Yeah, let's do that. And
yes,
please, Fineco, also think of an options a discussion on options trading for the newer beginner trader. Safety, and obviously safety is a big factor in that. So, but I would need time to prepare the content for that, because I haven't done the slides for that. But it would be a great topic that I think people need to be made aware of what their choices are, if you're interested.
Okay.
All right. Thank you very much, everyone. Thank you, Adam. Thank you, Simon. We'll see you next month, though.
21st of June. Thank you.
Thanks,
Thank you. Good day. Cheers.